Why did gold fall 20% in 4 months during a war? Were investors wrong to buy gold as a shield? Can ordinary investors use oil as a hedge? What is it that actually works when both gold and oil let you down? Hello and welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, there's a war in the Middle East. Oil is past $100, and the so-called safe haven, ultimate safe haven gold, it has erased the entire 20% gains of the year. The last fact is something that nobody expected. There's a war, gold should have risen, but it hasn't. What really happened? We'll talk about it in detail with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So first up, gold peaked near $5,600 in January. It is now around $4,400. How did that happen?
Because it was not about war. Gold went up because of central banks, and that happened in a different context. So central bankers were driving the gold, and that is what has dragged the gold. What happened was after the start of Ukraine war, the West froze Russian assets, and that sent a message that it is not safe to keep your assets or reserves in dollars. And that was the de-dollarisation, and central bankers went about investing in gold or buying gold over the last 3 straight years. China, Poland, India, Turkey, Kazakhstan, they have together bought something like 1,000 tons of gold. So if central banks are, blindly buying into gold, it has to go up, and it went up dramatically. And what is caused by the war, that some of these central banks are being forced to go and look for money. Look for money, sell gold. And that is what they are doing. And if you have it, this situation on the other side, that the sellers are central bank, it is not some temporary demand or temporary, it is not a Akshaya Tritiya, post Akshaya Tritiya slowdown or any such thing. When somebody bought this much, and if a part of it is being unwound or sold, it's bound to happen. So it was not about war. In fact, war has precipitated this fall.
Right. Now, many viewers are thinking that they bought gold thinking that this is the shield that they want to have for their portfolio. Were they wrong in thinking that?
Because everybody was not buying gold for any other reason, but they were chasing performance. They were buying gold because gold was going up. And gold was going up at a time when everything else was not going up, or everything else was struggling. So that is just the wrong reason to buy. The reason why you should think of gold as a fire extinguisher, that you are buying it so that when there is absolute calamity, this will be able to protect it. But it wasn't like that. Everybody thinks that what is the most opportunistic thing? The gold was the opportunistic buy which took it, and it actually became opportunistic thing or an opportunistic bet for investors because central banks were driving it. Not because other investors. So everybody felt as if they have lost out. They missed the bus, and everybody tried to catch the bus when the bus was
at full speed.
At full speed at a point where it actually decelerated.
Right. Coming to oil is spiking. Every Middle East conflict that brings the same question every time about oil. Should investors treat it like gold as a crisis hedge?
Oil and gold are completely different. Don't mix it up, because gold is a monetary asset. Gold is a reflection of people's trust in gold or their distrust in financial assets, so to say, at any given point. Oil is a commodity. You buy it, you consume it, and it actually drives your economy. And it is a very physical supply and demand drives the prices. And if the supply chain is getting disrupted, price go up. And not only the price go up, if there is extreme demand-supply gap, if there is just no supply, I think it can trigger a situation of bringing an economy to a standstill. Because not just transportation, there are all kind of energy variables which will be driving it. So oil price spike has a ripple effect across the industry, across economy. And one should look at it very differently. And we never had the sense of this scale of vulnerability with the rising demand. And this is something which we can't deal with overnight.
So can ordinary investors use oil as a hedge?
Ordinary investors should diversify. They should not look at, you can hedge, you can buy oil and petroleum companies stock and try and minimize, but I don't know whether they will suffer or whether they will benefit as a result of it, because most most of them are conglomerate or they're across the full value chain. The companies which are into exploration, they are also into refining, and their refining capacity is also dependent on the supply of those things. So it's very difficult for an individual investor who is doing 5,000, 20,000, 50,000 rupees SIP and trying to hedge oil. It's an opportunistic bet, opportunistic investor's bet. That is why you hire a fund manager. That is why you hire a fund manager, so that you are able to diversify. He's able to minimize your risk by taking a tactical position, by avoiding a tactical position which will suffer, and in a tax efficient way. You are not liable for any taxes till you realize your gains in a mutual fund. So I would say that most investors should just listen to it, hope that it does not become a calamity. And there is very little we can do except all the standard principles that we keep talking in Investors Hangout. Stick to it, believe in it, build a conviction, and hang around.
At a time when this volatile atmosphere, gold is going down, oil is too risky for an individual to use it as hedge or anything. What is it that actually works? Is there any asset that investors can rely on over a long period of time?
Of course, you have to rely on equity and you have to rely on fixed income. These are your primary asset in which you should be. Little bit of gold, so that you are imagining that, okay, when everything is in bad shape and just in case you need some money, here is something which will protect the value. Think of it like as an insurance, not the reason why people bought it in January. People bought in January because they thought that I can't miss it any further. And that is when everybody caught the peak. So asset allocation. Make sure that you have chosen an asset allocation depending on your cash requirement, your spending needs. Whether it is 5 years away, don't worry. Rebalance. Maybe this is creating an opportunity to move from fixed income to equity if you have something meaningful. If you started 1 or 2 years ago, use this opportunity that you are buying cheap. Don't look at the values every day. It is very difficult for a new investor to hang around when you see that market goes down by 1%, 0.5% every other day. But that is what optimizes your return. That is what creates opportunity for you. That is the promise of SIP. Make sure that asset allocation, diversified fund, and not being tactical, not chasing that next seasonal thing, not the next fashionable thing. I think that is all that you have.
All right. So let's bring it all together for our viewers now. If someone is watching this right now and they want to build a crisis-ready portfolio, what would be your advice for them?
My crisis-ready portfolio first will be, what is my asset allocation? Is it 65% equity? Is it 75% equity? Is it 80% equity? And how uncomfortable I am. Because in last 4 or 5 years, people have not been able to measure their risk tolerance. The real measure of risk tolerance is when you don't get a sleep after you look at the market values of your investments before sleeping. And first is that the fact that you are anxious to look at the value and then you get upset to lose your sleep is the break-even point, which means you have to reduce your equity a bit so that you are not getting, and then be able to think through it. Do you need the money? Do you need it tomorrow? Do you need it after 2.5 years? Can the market be in a very bad shape in another 2 years as well? Or this is your money which you need after 30 years and you're still getting worried, you're still losing sleep. So you have to find yourself. Second is that look where you are invested. Are those trendy things which you caught and are getting disappointed? That is something you should fix. So do some of these fixations. Asset allocation and be in diversified vehicle and not be into any tactical thing, and diversify better. If you are able to diversify internationally as and when possible, conveniently in a safe vehicle, do that. Investing in little bit in gold. So this will and being in good funds managed by good fund managers, which means your money has been entrusted to a guy who will worry about it and he will make sure that you don't really have sleepless nights forever.
And for someone with an all equity portfolio doesn't really need the money in the near term, they should.
Just check the health check of your the fund holdings, and that's about it. In fact, some of those investors should feel happy that you are buying cheap. That is what happens all over. Whenever you have this grand sale, people queue up to buy things. When it happens in the market, everybody runs away, as if they are investing to. You have any discount sale, people queue up. It gets crowded. Here is something where it goes down because people run away.
All right. So our takeaway is that gold was central bank driven. It has gone down. It makes sense now that we know that central banks are selling. That is what is happening. Yeah. Gold is an insurance, not a trade. Do not try to trade oil. Individual investors should own diversified equity funds. And the last one, and the most important one, it is important to stick to equity in lean times, because that is how you end up building wealth. That's all we have for you in today's episode. Keep watching the space for more information. Thank you. Bye for now.